Hello and welcome to our channel. In today's video, we'll be talking about big oil and their impressive cash reserves. As we speak, the 5 biggest oil companies in the world, ExxonMobil, Chevron, BP, Shell, and Total, are sitting on a combined cash pile of over $150 billion. That's a lot of money. But what does it mean, and what can they do with it? Let's find out. Oil and gas companies have built up a mountain of cash with few precedents in recent history. Wall Street has a few ideas on how to spend it, and new drilling isn't near the top of the list. We believe the world's thirst for oil will continue for years, if not decades, to come. The promise of money returned to shareholders helped turn energy shares into some of the few bright spots in a dark moment for markets last year, fueled by commodity prices that skyrocketed after Russia's invasion of Ukraine. The deceleration in oil producers' cash machine comes after energy prices pulled back from highs reached last year after Russia's full-scale invasion of Ukraine. But even with a $50 billion decline in annual profits, the companies would still rake in their second-highest earnings ever recorded. The U.S. major Chevron kicks off big oil's earnings season on Friday, followed by ExxonMobil next Tuesday and Europe-based Shell, BP and Total Energies in early February. The 5 companies' combined profits for the last 3 months of 2022 are forecast to be $41.8 billion, up more than 40% from $29.4 billion a year before. Their earnings are expected to be down 18% from the third quarter, however. Exxon flagged in a regulatory filing this month that lower commodity prices would reduce fourth-quarter earnings by as much as $4.1 billion from its record-smashing $19.7 billion in the third quarter. The warning still puts Exxon on track for one of its most profitable quarters on record. Why do oil companies have so much cash? So, why do these companies have such huge cash reserves? One reason is simply that they are incredibly profitable, despite the many challenges they face in terms of regulation, competition, and public opinion. In fact, the oil and gas industry has historically been one of the most profitable in the world. And when you're making billions of dollars in profit each year, it's not hard to accumulate a lot of cash over time. An analyst at Moody's said last year's huge cash influx had put the sector in the best place I have seen in the last 15 years. They will have a lot of flexibility in terms of how they want to use record levels of cash flow. Reflecting this strength, Chevron on Wednesday announced it will repurchase $75 billion of shares over an unspecified number of years. Government's increased focus on energy security after the Ukraine invasion has brought back some of the investors who shunned fossil fuel producers over climate-damaging emissions. The market's peak ESG concerns have been fading, said Matt Portillo, an analyst at Texas-based investment bank TPH, referring to environmental, social and governance investing. As investors shifted focus back to the company's core oil and gas businesses, it has been constructive for the equities, Portillo said. Oil and gas stocks led the Wall Street benchmark S&P 500 last year for the second year in a row, rising around 40% compared with the broad index's 14% decline. Fourth-quarter earnings from companies in the S&P Energy Subindex are expected to be 56% higher year-on-year, while earnings across the index will decline by 6%, according to Credit Suisse. Shares of U.S. oil super majors have outpaced European rivals, which have faced investor questions about their planned pivots away from fossil fuels. Still, the European companies are expected to report a sharp rise in fourth-quarter profits compared to 2021. U.S. shale oil and gas producers, led by companies such as Pioneer Natural Resources, Devon Energy and Occidental Petroleum, have undergone an especially pronounced economic revival, turning out record amounts of free cash flow after more than a decade of dismal returns. Rystad Energy, a consultancy, expects the shale sector to produce about $120 billion of free cash flow, or money left over after operating and capital expenses, in 2023. That would be down from $156 billion last year, but a reversal from years when spending exceeded profits. Shale companies have shifted away from using cash to fund aggressive new drilling campaigns towards handing the lion's share back to shareholders through dividends and stock buybacks. This in turn has tempered production growth and helped prop up oil prices. Analysts will be watching shale companies' drilling plans this earnings season for signs of a renewed focus on growth. What can they do with all that money? So, what can these companies do with all that cash? Well, there are a few different options. One possibility is that they could invest in new projects, such as exploring for new oil and gas reserves or developing alternative energy sources. This would help to ensure their long-term viability and growth, even as the world transitions away from fossil fuels. Another option would be to use the cash to pay down debt or buy back their own shares, which would increase the value of those shares and benefit their shareholders. They could also use the money to pay dividends, which would provide a steady stream of income to their investors. Finally, they could simply hold onto the cash as a reserve, to be used in case of emergencies or unexpected events, such as a sudden drop in oil prices, a major accident or disaster, or a global economic downturn. Conclusion. In conclusion, the fact that big oil has over $150 billion in cash reserves is a testament to the industry's profitability and resilience. But it also raises important questions about how that money should be used, given the urgent need to transition away from fossil fuels and address the many environmental and social challenges we face. Whatever the future holds, it's clear that these companies will continue to play a major role in the global economy for years to come. Thank you for watching.